They don't react. They strategize. Most people lose money in the stock market, not because the market is dangerous, but because they become emotional. They buy when they feel excited. They sell when they feel scared. They follow rumors, tips, hype, and then blame the market. But smart investors are different. Smart investors don't react. They strategize. They treat investing like a science of strategy, patience, and control. They don't depend on luck. They depend on planning. They don't depend on predictions. They depend on discipline. They don't follow the noise. They follow a system. And that is what makes them truly intelligent. In this video, I will show you how the smartest investors think, act, and grow their wealth. Not by being fast, not by being lucky, but by being steady, safe, and strategic. You will learn how smart investors make decisions, how they handle risk, how they stay calm in market crashes, how they grow money slowly but surely, and how you can follow the same mindset. So, sit back, take a deep breath, and get ready to understand the real art of smart investing. Because if you want long-term wealth, not tension, not stress, not gambling, then this video will change the way you look at the market. Let's begin.
Chapter 1. What smart investing really means. Before we learn how to invest smartly, we must understand one simple truth. Investing is not gambling. But many people treat it like gambling, and that is why they lose. Let's make this clear. Gambling means you guess, you hope, you depend on luck, you get emotional. Investing means you plan, you study, you stay patient, you understand risk. Both look similar from the outside, but inside, they are completely different worlds. Smart investing equals logic plus long-term thinking plus risk awareness. Smart investing is not about becoming rich fast. It is about becoming rich surely. It is about using your brain, not your emotions. It is about taking decisions that make sense 5 years from today, not decisions that only feel good for the next 5 minutes. Smart investing says, even if the market goes up, I will stay calm. Even if the market crashes, I will stay calm. Because your goal is not to react, your goal is to stay consistent. Planning, not predicting. Most people try to predict the market. Tomorrow it will go up. Next week it will fall. Now is the best time to buy. Now is the best time to sell. But the truth is, nobody knows, not even experts. Smart investors don't waste time predicting the future. They prepare for the future. They ask questions like, is this company strong? Is this stock overpriced? Does this fit my long-term plan? How much risk can I handle? They invest with a plan, not a prediction. Why smart investing works? Because you avoid emotional mistakes. You avoid reacting to news. You avoid panic selling. You avoid greed buying. You protect your money. You grow your money steadily and safely. Smart investing does not give excitement. It gives stability. It does not give quick highs. It gives long-term wealth. Final message of Chapter 1. Smart investing means think long-term, control your emotions, understand your risks, follow a plan, grow slowly, steadily, and safely. If you understand this, you're already ahead of 90% of people in the market.
Chapter 2. The Power of Financial Goals. Most people invest without direction. They buy one stock today, sell another stock tomorrow, follow one tip next week, and then they wonder, why am I not getting results? The truth is simple. Smart investors never invest randomly. They invest with a purpose. Why goals matter in investing? Think of investing like a road trip. If you don't know your destination, you will drive in circles, waste time, and waste fuel. The same happens with your money. Goals act like your Google Maps. They give direction, clarity, and priority. When your goal is clear, your investment decisions become clear. Types of financial goals every smart investor sets. Smart investors set four main types of goals. 1. Long-term security, retirement. This is the goal most people ignore, but smart investors understand. One day, my job will stop. My money should not stop. This goal decides how much to invest, what type of assets to choose, how long to stay invested. 2. Financial freedom. This means you don't work for money. Money works for you. For this goal, smart investors choose stable stocks, SIPs, index funds, passive income assets. Freedom comes not from luck, but from consistent investing. 3. Safety and emergency protection. Life is unpredictable. Medical bills, job loss, family needs, anything can happen. Smart investors always keep emergency fund, low-risk investments, safe assets. Why? Because the first rule of money is protection. 4. Wealth growth. This is the exciting part. Growing money, multiplying wealth, taking calculated risks. But smart investors do not chase hype. Their growth plan is based on research, logic, risk tolerance, and time horizon. They grow their money with discipline, not emotion. How goals decide strategy. Your goal decides what to buy, how much to invest, how long to hold, how much risk to take, which mistakes to avoid. Example, if your goal is retirement, you won't panic sell when the market falls. If your goal is wealth growth, you won't put all money in safe assets. Goal equals strategy. Strategy equals results. Without goal, there is confusion. With goal, there is confidence. Final message of Chapter 2. Smart investors don't rely on luck. They rely on clarity. They know why they are investing, and that why gives them the strength to stay patient, stay disciplined, and stay focused. Remember, a financial goal is not just a dream. It is a roadmap to your future. Chapter 3. Understanding Risk Like a Pro. Most people think investing is dangerous. But the truth is, money is only risky when you don't understand it. Smart investors don't fear risk. They study risk. They respect risk. And they manage risk before thinking about profit. This is what separates professionals from beginners. Underscore. What is risk in investing? Risk simply means there is a chance things may not go as planned. Every investment has risk, but the level of risk depends on your knowledge, patience, and decisions. Smart investors don't ask, how much money can I make? They ask, how much can I lose and can I handle that? Underscore. 3 major types of risk every investor must know. 1. Market risk. When prices go up and down. This is the most common risk. Markets rise, markets fall. Sometimes without reason. Sometimes because of economy, news, politics, war, inflation, etc. You cannot control the market, but you can control your reaction. Smart investors handle market risk by staying long-term, not panicking, buying quality companies, avoiding timing the market, investing regularly SIP style. Market risk affects everyone, but only emotional people lose money from it. 2. Emotional risk, your feelings can make you poor. This is the most dangerous risk because your emotions can destroy your profit faster than market crashes. Emotional risks include fear, selling at loss, greed, buying at high price, FOMO, following trends blindly, panic, running away from the market. Smart investors remain calm, logical, and patient, no matter what the market does. Their rule is simple: control your emotions, or your emotions will control your money. 3. Overconfidence risk, thinking you are always right. Overconfidence destroys more wealth than bad stocks. Some people invest like this: I know everything. I can't lose. This stock is guaranteed. I can double my money fast. This is a trap. Smart investors stay humble. They know anything can happen, no one is always right, no stock is 100% safe, no prediction is guaranteed. Overconfidence creates big losses. Humility creates long-term wealth. Underscore. How smart investors manage risk. Here is the formula professionals follow. Study before investing, diversify your portfolio, never invest all savings in one stock, use long-term mindset, avoid emotional decisions, always keep a safety margin, accept that the market will fluctuate. Smart investors don't run from risk, they prepare for it. Underscore. Final message of Chapter 3. Every investment carries risk, but the biggest risk is not knowing what you're doing. Smart investors understand profit is not earned by bravery. Profit is earned by managing risk carefully. Remember, focus on protecting money first. Profits automatically follow.
Chapter 4. The Magic of Compounding. If there is one concept that can make you rich even with small money, it is compounding. Most people think wealth is created by big income or big investments, but smart investors know the truth. Money grows slowly at first, and then suddenly. Compounding is not loud. It is not exciting. It is your silent partner that works every single day, even when you are not. Springleaf. What is compounding? Compounding means your money earns money, and then that money also earns money. It's like planting a small seed. At first, nothing special happens, but with time, the seed becomes a plant, then a tree, and one day, that tree becomes a forest. That is compounding. Time clock, why starting early matters so much. Compounding has one best friend: time. Earlier you start, the bigger your results, because compounding needs years to show magic. Two people investing 5,000 rupees per month. Person A starts at age 25. Person B starts at age 35. Both invest till age 60. Person A ends with double the money of person B, even though both invested the same monthly amount. Why? Because person A gave compounding more years to work. Time is more powerful than money. Moving star graph. Slow, 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 boom. In the beginning, compounding feels boring. First year, small growth. Fifth year, still small growth. 10th year, slightly better growth. 15th year, now growth becomes bigger. 20th year, suddenly money multiplies fast. 25th year, money starts exploding. This is why most people fail. They give up early. They expect quick profit. They stop investing before the magic begins. Smart investors stay consistent. They know
Compounding rewards patience, not excitement. Bulb Quick: how smart investors use compounding. Smart investors follow 3 simple rules. 1. Start early. Even small amounts can grow huge when given time. 2. Stay invested. Don't interrupt compounding by panic selling. 3. Increase investments slowly. As income grows, investment should also grow. That's how wealth becomes automatic. Woman practicing yoga. Compounding teaches a beautiful life lesson. Everything big in life comes from small, consistent efforts, whether it's health, learning, business, or investing. Small steps, repeated for long time, create massive results. Compounding is not just a financial principle, it is a life principle. Microphone: final message of Chapter 4. Compounding doesn't need you to be rich. It only needs you to be patient. Even 500 rupees or 1,000 rupees invested regularly can become powerful wealth. Remember, you don't grow rich by doing big things. You grow rich by doing small things for a long time. Compounding is slow, until one day it becomes unstoppable.
Chapter 5. The 3 Smart Investor Mindsets. When people think about investing, they imagine charts, formulas, fancy numbers, and big profits. But the truth is very simple. Your mindset decides your success more than any market knowledge. Smart investors don't just study companies, they study themselves. They master 3 powerful mindsets that separate winners from losers. Let's break them down one by one. Meditator 1. Patience, the most powerful investment skill. Most people lose money not because the market is bad, but because they are impatient. They want fast returns. They want instant results. They want profit in weeks instead of years. But smart investors know wealth grows slowly, quietly, and steadily. Patience helps you hold strong companies for years. Ignore temporary market drama. Stay calm during dips and crashes. Let compounding do its magic. When you are patient, time becomes your partner. When you are impatient, time becomes your enemy. Bricks 2. Discipline, doing the right thing every time. Discipline is not exciting. It is not glamorous. It is simple actions repeated again and again. Smart investors follow discipline like a routine. Invest monthly. Follow their plan. Avoid unnecessary risks. Don't chase hype. Stick to long-term strategy. Even on days when they feel lazy or doubtful, they still follow the plan. Discipline is the bridge between dreams and reality. Without discipline, even the best strategy fails. Ice Cube 3. Emotional control, the shield against market chaos. The stock market has only 2 emotions, greed and fear. Greed makes people buy high. Fear makes people sell low. Both kill wealth. Emotional control means not panicking when the market falls, not getting excited when the market rises, not following crowd behavior, not mixing feelings with decisions. Smart investors behave like surgeons, calm, steady, logical, and focused. They understand that emotional decisions create maximum losses. Thought, mindset greater than market knowledge. You can learn charts. You can learn analysis. You can learn all the financial terms. But if you don't master patience, discipline, and emotional control, none of that knowledge will help you. A strong mindset protects you in every situation: bull market, bear market, crash or correction, hype or fear. Knowledge gives you information. Mindset gives you power. Microphone:
Final message of Chapter 5. Smart investing is not about being the smartest person in the room. It is about controlling yourself better than anyone else. Master these 3 mindsets: patience, discipline, and emotional control. And you will make wiser, calmer, and more profitable decisions, not just in the market, but in life.
Chapter 6. Building your smart portfolio. A smart investor never puts all money in one place. Why? Because the market is unpredictable. Anything can happen. A crash, a recession, a global event, a bad news cycle. So smart investors build something powerful, a balanced portfolio that protects and grows their money at the same time. This is the real art of investing. Step 1. Mix growth and safety assets. A strong portfolio has 2 main parts. 1. Growth assets. These are investments that grow fast but can go up and down. Examples: stocks, equity mutual funds, index funds, real estate, businesses. These help your money grow big over time. 2. Safety assets. These give stability and protect you during bad times. Examples: bonds, FD or fixed deposits, gold, liquid funds, government securities. These keep your capital safe when the market is shaking. Smart investors balance both. They don't depend only on risky assets. They don't depend only on safe assets. They combine both to get growth plus protection. Step 2. Balance according to age and goals. Your portfolio should change with your life stage. If you are young, 18 to 30, you can take more risk because you have more time to recover. Your portfolio can be 70 to 80% growth assets, 20 to 30% safety assets. Middle age, 31 to 45. You balance growth and security. 60% growth, 40% safety. Above 45 to 50. You protect your wealth more. 40% growth, 60% safety. This is not a strict rule. It is a smart guideline so that your money does not depend only on luck or short-term movement. Step 3. Match portfolio with your personal goals. Different goals need different strategies. Short-term goals, 1 to 3 years. Examples: buying phone, bike, vacation. To high safety, low growth. Mid-term goals, 4 to 7 years. Examples: marriage, car, down payment. To balanced growth and safety. Long-term goals, 10 plus years. Examples: retirement, dream home, wealth building. To high growth assets. Smart investors don't ask, "Where should I invest?" They ask, "What is my goal?" Goals decide the plan. Plan decides the portfolio. Step 4. Portfolio must protect and grow. A smart portfolio does 2 things. 1. Protects your money during bad times. Even if the market falls, your safety assets save you from big losses. 2. Grows your money during good times. Your growth assets take advantage of opportunities and increase wealth. This balance gives you peace of mind. No fear, no panic, no overexcitement. Just steady progress. Final message of Chapter 6. Smart investors don't gamble. They design their portfolio like an engineer, carefully, logically, and according to their life goals. Remember, a well-balanced portfolio is the strongest weapon against uncertainty. Growth builds wealth. Safety protects wealth. A smart portfolio combines both. Chapter 7. Research like an intelligent investor. Most people lose money in the stock market not because the market is bad, but because they don't know what they're buying.
They buy because a friend told them. They buy because of Twitter, YouTube, or rumors. They buy because the price is going up fast. But smart investors follow one simple rule. Never invest blindly. Research is your protection. Let's break down how intelligent investors research properly. Study fundamentals, not rumors. Rumors, tips, and hype will make you excited, but they will never make you rich. Real wealth comes from understanding the business, not the noise. Smart investors ignore WhatsApp tips, Telegram groups, hot stock news, pump and dump hype, emotional predictions. Instead, they focus on facts. Fundamentals equal the true health and strength of a company. Understand the business quality. Before investing, ask yourself, what does this company do? How does it make money? Will it still be relevant after 10 years? Is it better than competitors? If you cannot explain the business in simple words, you should not put your money into it. Intelligent investors only invest in strong, simple, long-lasting businesses. Check debt levels carefully. Debt can destroy a company during tough times. A high-debt company is like a person drowning in loans. One shock and everything collapses. Look for low or manageable debt, healthy cash flow, ability to repay loans easily. Smart investors prefer companies that can survive financial storms. Study earnings and profit stability. The company should not show random profits. Profits must be stable, growing consistently, and predictable. If a company earns well year after year, it means the business model is solid. If profits jump one year and fall next year, that is a red flag. Evaluate the management quality. A company is only as strong as the people who run it. Good management is honest, skilled, long-term focused, transparent, and shareholder-friendly. Bad management destroys wealth even if the business looks strong. Smart investors check CEO's track record, company ethics, decisions in crisis, past mistakes. Trust the management before trusting the stock. Smart investing begins with smart research. Research is not boring. It is the difference between safe profit and big loss. Intelligent investors read annual reports, compare companies, study financial statements, understand the industry, make decisions based on logic. Because research is not about predicting the future. It is about understanding reality. When your research is strong, your confidence is strong. When your confidence is strong, your returns are strong. Final message of Chapter 7. Smart investing is not about luck. It is about clarity. Study the business. Understand the numbers. Check the management. Ignore the market noise. Because money grows when your decisions are wise, and your decisions become wise when your research is strong.
Chapter 8. Diversification, your safety net. In the stock market, there is one truth every smart investor understands. Never put all your money in one place. Because the market is unpredictable. A single bad news, a single industry crash, a single company mistake can destroy your entire investment if everything is in one stock. Diversification is not just a strategy. It is your safety net, your protection, your peace of mind. Arrow 1. Why you should not depend on one stock. Even the biggest, safest,
most respected companies can fall. History shows giants collapse, industries fail, unexpected events happen, market cycles change. If all your money is in one stock, you are depending on luck, not intelligence. Smart investors know one stock can make you rich, but it can also make you broke, so they never take that risk. Graph 2. Spread money across sectors. Every sector performs differently at different times. Examples: tech may rise, banking may fall, pharma may stay stable, FMCG may protect during recessions. So smart investors spread their money across technology, financial services, pharma, energy, FMCG, auto, and infrastructure. This way, if one sector falls, other sectors support your portfolio. Diversification smooths your returns and reduces stress. Package 3. Invest across different asset classes. Don't depend only on stocks. Mix different types of investments like equity for growth, debt or bonds for stability, gold for inflation protection, real estate for security, index funds or mutual funds for balance. Each asset class behaves differently. Together, they create a strong, stable portfolio. This protects you from unexpected market shocks. Graph 4. How diversification protects you in crashes. When the market crashes, some stocks fall heavily, some fall lightly, some stay stable, some even rise. If you are diversified, your portfolio doesn't collapse completely. You lose less, you recover faster, you stay confident. Diversification is like wearing a helmet. You hope you never need it, but you will be grateful when things go wrong. Mike 5. Diversification is not playing safe. It is playing smart. Some people think diversification means low returns. This is wrong. Diversification gives stability, consistency, protection, and long-term strength. Smart investors don't chase the highest return. They chase the safest long-term return. Diversification makes your wealth grow steadily, without big shocks or sleepless nights. Final message of Chapter 8. Diversification is the rule every intelligent investor follows. Don't depend on one stock. Don't depend on one sector. Don't depend on one asset class. Spread your investments wisely. Protect your money from surprises. Build a portfolio that survives any market condition. Remember, in investing, safety is not weakness, it is your greatest strength.
Chapter 9. Systematic Investing, SIPs, and Automation. Most people lose money in the stock market, not because the market is bad, but because their emotions are bad. They invest when they feel excited. They stop when they feel scared. They buy high, they sell low. This emotional cycle destroys wealth. Smart investors avoid this trap by using something powerful: systematic investing, automatic, disciplined investing. 1. What is systematic investing? Systematic investing means investing a fixed amount every month, without skipping, without thinking, without waiting. You invest whether the market goes up, goes down, stays flat. This removes emotions from the decision. It is simple, steady, and stress-free. 2. Why SIPs beat timing the market? Most people try to time the market, buy at the lowest point and sell at the highest point. But let's be honest.
Nobody can perfectly time the market. Not experts, not analysts, not even legendary investors. SIP solves this problem automatically. By investing monthly, SIP gives you the benefit of rupee cost averaging. You buy more when prices are low, less when prices are high. Long-term growth. Your money stays invested for years. Consistency. Small steps become big wealth. SIPs don't depend on luck. They depend on discipline, and discipline always wins. 3. Automation removes emotions. Automation means money automatically gets invested. You don't have to remember dates. You don't have to think about the market. You don't panic during market crashes. When you automate your investing, no fear, no excitement, no overthinking, no stopping. Automation protects you from your own emotions, your biggest enemy in investing. 4. SIPs work for all kinds of investors. SIPs are perfect for salaried people, students, beginners, busy professionals, people who don't want stress, long-term wealth builders. Even if you start with small amounts like 500 rupees, 1,000 rupees, or 2,000 rupees per month, you create a powerful habit. Small monthly investments become big future wealth. 5. SIPs shine during market crashes. During a market crash, most people stop investing or withdraw money. This is the biggest mistake. But SIP investors? They quietly keep investing every month, and because prices are low, they buy more units. This increases long-term returns. SIPs turn market crashes into wealth opportunities. This is why SIP investors recover faster and grow stronger. 6. SIP equals discipline plus time equals wealth. Wealth is built with time, patience, consistency. SIP combines all three. You don't need to be an expert. You just need to stay regular. SIP is not magic. It is mathematics plus discipline. Final message of Chapter 9. Smart investors don't depend on emotions. They depend on systems. SIPs and automated investing make your financial life simple, steady, stress-free, and powerful. Investing becomes a habit, not a struggle. Remember, if you invest automatically, wealth grows automatically. That is the power of systematic investing.
Chapter 10. The Art of Buying and Holding. In today's world, everyone wants quick results, quick money, quick profits, quick success. But in investing, the smartest people know one truth. Real wealth comes from patience, not speed. Smart investors don't spend their whole day trading. They don't sit in front of charts. They don't chase rumors. They do something much more powerful. They buy quality and hold for years. Why smart investors don't trade daily? Daily trading looks exciting, but for most people, it leads to stress, losses, overthinking, emotional decisions. Trading is like running on a treadmill, a lot of movement, very little progress. But investing is like walking a long, stable road. Slow steps, but every step takes you forward. Smart investors know you don't get rich by reacting every day. You get rich by staying patient for years. The secret: time in the market. Most people try to time the market. They try to guess. When is the bottom?
When is the top? When should I buy? When should I sell? But even experts fail at this. The real power is in time in the market, not timing the market. When you stay invested for long periods, your money compounds, your wealth grows quietly. Temporary ups and downs don't matter. Long-term growth becomes massive. 10 years of holding beats 10 days of trading, always. Buying quality and holding for years. Smart investors look for strong companies, stable earnings, low debt, trusted management, long-term growth potential. They buy these companies at a good price, and then they hold. Not for 1 month, not for 1 year, but for many years, sometimes even decades. Why? Because a strong business keeps growing. And when the business grows, your wealth grows automatically. Holding good companies is like planting a mango tree. You don't dig it every week to check growth. You just water it, give it time, and one day it gives fruit for life. Market ups and downs don't matter to holders. Daily market movements don't affect smart investors. When the market goes up, they stay calm. When the market goes down, they stay calm. Why? Because they understand crashes are temporary, emotions are dangerous, long-term value always rises. Short-term noise doesn't disturb long-term growth. Long-term holding equals compounding superpower. When you hold for years, something magical happens. Compounding. Your money earns money, and that money earns more money, and it keeps growing. This is why long-term investors often become wealthy, even if they invest small amounts. Compounding rewards patience more than intelligence. Final message of Chapter 10. Smart investing is not about acting fast. It's about staying committed. Buy quality, hold with patience, trust time, ignore noise. Because in the market, speed creates stress. Patience creates wealth. Real investors don't chase profits every day. They build wealth slowly, steadily, silently. That is the art of buying and holding.
Chapter 11. Avoiding Common Investor Mistakes. Most people don't lose money in the stock market because of the market. They lose money because of their own behavior. Smart investing is not only about what you should do, it is also about what you should never do. In this chapter, let's understand the biggest mistakes normal investors make and how smart investors avoid them every single time. Number 1. Chasing hype. Every few months, you'll see a new hot stock or trending company. People rush in because everyone is talking about it. Social media is pumping it. News channels are screaming, buy, buy, buy. But hype has no logic. Hype has no fundamentals. Hype is just noise. Smart investors never chase hype. They chase value, not popularity. Because by the time you hear the hot news, big players have already bought early, and small investors get trapped at the top. Number 2. Panic selling. When the market crashes, most people panic. Sell everything. I don't want to lose more. But panic is the fastest way to destroy wealth.
Market falling is normal. Market crashing is normal. Market recovering is also normal. Smart investors stay calm in both good times and bad times. They don't sell just because the market is red. They sell only when the business becomes weak, not when the price becomes cheap. Panic selling turns temporary losses into permanent losses. Smart investors avoid it. Number 3. Overconfidence. Many beginners make one profit and suddenly think, I'm a genius. I can predict everything. I will become a crorepati in 1 year. Overconfidence is dangerous. It leads to taking big risks, buying more than you can handle, ignoring research, assuming you can't be wrong. Smart investors stay humble. They know the market is bigger than them. They respect risk first, profit second. They research more and assume less. Number 4. Investing without a plan. The biggest mistake. People invest randomly. Some buy because a friend recommended. Some buy because a YouTube video said multi-bagger. Some buy because the stock looked cheap. But without a plan, you are simply gambling. Smart investors always have a plan. Why am I buying this stock? What is my goal? How long will I hold it? When will I sell it? How much of my portfolio should this stock be? A plan protects you from emotional decisions. A plan gives clarity. A plan keeps you disciplined. Final message of Chapter 11. Smart investors avoid the 4 biggest traps. No hype chasing, no panic selling, no overconfidence, no random investing. Why? Because avoiding mistakes is more powerful than making perfect predictions. In investing, safety comes before success. And that is why smart investors stay winning.
Chapter 12. Financial Freedom Through Smart Investing. Everyone wants financial freedom, but most people think financial freedom means being super rich, buying luxury cars, or living a fancy lifestyle. The truth is much simpler. Financial freedom means control. Control over your time. Control over your choices. Control over your future. And the smartest way to achieve that control is through smart, safe, long-term investing. Freedom is not about money. It is about choices. Money alone does not give freedom. High salary does not give freedom. Even a big bank balance does not give freedom. Real freedom is when you don't work out of fear. You don't stress about bills. You don't depend on luck. You don't live under pressure. Freedom means you choose how to live, not your job, not society, not your bank account. Smart investing helps you build this freedom slowly and safely. Smart investing makes money work for you. Most people work hard for money. Smart investors make money work hard for them. When you invest wisely, your money grows even while you sleep. Your savings turn into strong assets. Your future becomes more secure. You don't rely on salary alone. You don't depend on others. You build your own financial engine. This slow, steady growth becomes your biggest source of confidence. Safety plus growth plus consistency equals real wealth. Financial freedom is not created by shortcuts. It is created by balance. Safety. Protect your money with diversification, good research, and low-risk investments. Growth. Choose assets that appreciate with time, quality stocks, SIPs, index funds, strong companies. Consistency. Invest every month, even if the amount is small. Never stop. Never rush. Never panic.
This formula creates wealth that lasts for decades, not months. The journey is slow, but worth it. Smart investing is not exciting. It is not fast. It is not glamorous. But it works. It gives you long-term stability, peace of mind, financial security, confidence to live life on your own terms. You don't need to be a millionaire today. You just need the discipline to show up consistently and let money grow quietly. Final message of the book. Financial freedom is not a dream. It is a result of smart decisions taken again and again. If you choose discipline over excitement, logic over emotions, long-term over shortcuts, then your future will be strong, calm, and wealthy. Remember, freedom isn't just about money. It's about control. Smart investing gives you that control forever.
At the end of the day, the stock market does not reward the fastest. It does not reward the loudest. It does not reward the people who act out of fear, greed, or excitement. The market rewards the patient, the disciplined, and the intelligent, the people who follow a plan, the people who stay calm when others panic, the people who invest with sense, not with emotions. Most people lose money because they want quick results. Smart investors build wealth because they think long-term. One group reacts, the other group strategizes. And that is the real difference. You don't need to be a genius. You don't need to know everything. You just need the courage to start small and the discipline to stay consistent. Because smart investing is not magic, it is mastery. Mastery of your money, your emotions, and your decisions. If you stay steady, if you stay focused, if you stay patient, time will do the miracle. Final line, invest smart, live free.